All right, let's dive right in. Today, we're talking about one of the single most powerful tools for really understanding a business, return on invested capital, or ROIC. You can think of it as the ultimate test to see if a company is genuinely creating wealth or, well, just burning through cash. So let me start by asking you a question. You see it all the time, right? Headlines about companies with soaring sales, expanding across the globe. But does all that growth automatically make it a good company, a great investment? The answer, and this might surprise you, is a hard no. Okay, so if growth alone isn't the answer, how do we tell the good from the bad? Well, it all boils down to this really elegant idea from our source material at Morgan Stanley. They call it the $1 test, and it is a beautifully simple, powerful way to think about this whole idea of creating value. So here's our game plan. We're going to start with that $1 test. Then, we'll introduce our hero metric, ROIC. We'll pop the hood and see exactly how the formula works using a real-world example, then explore why the stock market cares so much about it. And finally, we'll hit a crucial reality check called the Great Fade. First things first, the $1 test. You know, most people think that if a company is profitable, then it must be doing a good job. It must be creating value. But it turns out just having positive numbers on the bottom line, that's not the whole story. Not even close.
Just look at this. It lays it out perfectly. On the left, you've got a company on what you could call a growth treadmill. Yeah, it's investing, it's growing, but it isn't actually getting any richer. It's just running in place. Now, what you want is the company on the right. That's valuable growth. Every dollar it invests is like planting a seed that grows into more than a dollar. That's the game we want to be in.
So that begs the question, right? If simple profit isn't good enough, what metric should we be looking at? Well, this is where the star of our show makes its entrance: return on invested capital. This is the yardstick that lets us measure true value creation and see who's really passing that $1 test. And here it is. Now, don't let your eyes glaze over. I promise this formula looks a lot scarier than it actually is. At its core, it's just a simple ratio: net operating profit after taxes, or NOPAT, divided by invested capital. And don't worry, we're about to break down exactly what each of those means. So what does this actually tell us? In plain English, ROIC answers a really simple question. For every single dollar a company has put to work in its business, we're talking everything from factories to software code, how much profit is it actually spitting out? It cuts through all the noise and measures how good a company is at its core business. Okay, enough with the theory. Let's get our hands dirty and see how this works in the real world. We're going to walk through the whole calculation using a company we all know, Microsoft. This will show you exactly how you go from a boring financial statement to this incredibly powerful number. So first up is that top number, the numerator, NOPAT. The best way to think of this is as a company's pure, unleaded operating profit. The whole point of it is to strip out all the financial engineering, how much debt they have, so we can get a true apples-to-apples comparison of the actual business operations between, say, Microsoft and any other company. And here's the actual math for Microsoft's 2022 fiscal year. You can see we start with their operating income, we make a couple of small adjustments, and then we subtract the taxes they actually paid. And boom, we land at a NOPAT of $70 billion. So that's our top number. Now for part two, the bottom number, the denominator. This one's called invested capital, and it's basically just all the stuff. It's all the money that's tied up in the business to make those profits happen. We're talking their buildings, their equipment, their inventory, and even intangible stuff like the goodwill they paid when they bought another company. And here's that breakdown from Microsoft. You can see the big chunks right there, from physical property to those intangible assets. When you add it all up, you get a grand total of $165 billion in invested capital. That's the total pile of money Microsoft has to work with. All right, moment of truth. We take that $70 billion in NOPAT, we divide it by the $165 billion in capital, and we get 49%. Now just stop and think about that for a second. For every single dollar Microsoft has invested in its business, it generated 49 cents of pure profit in 2022. That is an absolutely staggering number. Okay, 49% is a huge number, but so what? Why should you as an investor actually care? Well, this is where it all clicks into place. We're about to see the direct, undeniable link between this one metric and a company's stock price. Take a look at this chart. Along the bottom, you've got a company's ROIC, how good it is at turning capital into profit. And going up the side, you've got how the market values that company. I mean, the trend is crystal clear, isn't it?
The higher your return on invested capital, the more the stock market is willing to pay for your business. The market absolutely loves this.
And that's because, at the end of the day, investors are really just trying to do one simple thing. And this quote here from Michael Mauboussin just nails it. They want to put $1 in and get more than $1's worth of value back out. That's the whole game. And ROIC is probably the best scorecard we have for seeing which companies are doing exactly that.
Now, before we all get excited and rush out to buy companies with a 49% ROIC, hold on. There's a crucial reality check we need to talk about. It's a concept known as the Great Fade. See, what this chart shows is a really powerful force in business, and in life, really. It's called regression to the mean. That top line represents the superstar companies with the highest ROICs. But notice what happens over time. It drifts downward, back toward the average. And it makes perfect sense, right? If you're making insane profits, everybody else wants a piece of that pie. Competition rushes in, and those amazing returns get eroded. Staying at the very top is incredibly difficult.
So, let's just quickly recap the big ideas. Number 1, not all growth is good growth. It has to pass that $1 test to be worthwhile. Number 2, ROIC is our best yardstick for measuring that true value-creating power. Number 3, the market gets it. High ROIC companies get rewarded with high valuations. And finally, number 4, the great fade is real. Being great is one thing, but staying great is the real long-term challenge.
Which brings us to our final thought. Armed with this knowledge, take a look at the most successful companies in the world today. The real multi-billion-dollar question isn't just how profitable they are right now, it's whether they have a strong enough competitive advantage, a deep enough moat to defy that great fade and keep creating value for years and even decades to come.